Okay, today we're going to talk about how severely inflation is impacting the interest rates that are used to calculate the ExxonMobil pension lump sums. My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. Before I get started, just want to remind everybody that the Retirement Group, we are not employed by, nor are we affiliated with ExxonMobil. However, we've been working extensively with employees and retirees for many years, helping them navigate the transition into retirement, and especially covering topics like this, the pension plan, whether to take the annuity, whether to take the lump sum, how interest rates are going to affect you, and when's the best day to retire to meet your goals. But we've seen some of the biggest jumps we've ever seen quarter to quarter in the history of the lump sum calculations, and especially going back to the PPA segment rates of 2008. So what's happened? Obviously, we've seen inflationary pressures for the last year, but it's skyrocketed so far in 2022, and that's leading to higher interest rates that are used to calculate the pension lump sum. So the ExxonMobil pension plan, it's a classic defined benefit plan, in which case there's a formula that's used to calculate out what your single life annuity is going to be for the rest of your life. From there, you can decide to take it as a joint survivor if you're married, or if you want to do a period certain to make sure you get payments if something happens to you earlier. Or you can take it as a lump sum if you think you want to take that money, manage it yourself, or work with a firm to try and outperform what that annuity could have been. Or you want to make sure it leaves a legacy, or you make sure your beneficiaries capture more of that benefit from the pension as well. So what happens is they look at that current annuity payment they have to give you, look at your age, and then look at life expectancy to figure out how many more months or years we have to pay you, and then look at interest rates to calculate the net present value calculation. So when interest rates are lower, like they are right now or have been the last couple of years, they have to give you a higher lump sum. So thanks to the pandemic and driving down interest rates, we've seen some pretty large lump sums over the last few years. But that's not just changing slowly; it's changing rapidly right now, and we're seeing those drop back to levels of 2019 and before. So what happens is they look at different interest rates. There's the GAT rate, which is used for grandfather employees, those of you who have been around a little bit longer, and they use that. It's tied to the 30-year Treasury, so it's a little bit better rate. And if we look at this chart here on the right-hand side, that's actually jumping up from 1.75% to 2.25% in the third quarter. The average came out to 2.14%, so there should be rounding to 2.25%. So what happens is when we see those interest rates change, roughly a 1% change in interest rates is going to affect you by about 8 to 12% in your pension lump sum calculation. So a 1% change means you're going to see probably about a 10% reduction or so in your lump sum. So for those grandfather employees, and I'm working with a few right now that are going through this process and are pulling the trigger for third quarter, now that we have the rates in, they're going to be losing 5% if they decide to stay into the third quarter. So for somebody that's got $1 million lump sum right now, that's about $50,000. If you had a higher $2 million lump sum, that's $100,000 just in one quarter. Now, unfortunately, it gets worse for you, those of you who are not grandfathered. If you're not grandfathered, you're under what are called the PPA segment rates, which were introduced back in 2008. And those are three different segments. There's the first, second, and third segment. So they're going to be focused on the short term, mid-term, and long term. The first one is years 1 through 5. Second segment, years 6 through 20. And the third segment, years 21 and beyond. So for most of us, that middle segment is going to have the highest impact on us because it is 15 years in retirement. So let's take a closer look at that. What they do for the Pension Protection Act segment rates is they look at the average of the last 2 months of the previous quarter. So let me zoom into this chart here. If we look at the top two lines, we can see where February and March came out. And we look at that middle segment at 3.35% and 3.71%. That gives us the average on that third line, Q3 2022 blended rates, which are the ones going to be used for the pension calculation, of 2.16%, 3.53%, and 3.82%. Now again, focus on that middle segment, that 3.53. If we look one line below there, right now in the second quarter, it is 2.72%. And just recently in the first quarter, it was 2.53%. So I mentioned again the 50 basis point or 0.5% change that we saw from the grandfather employees. It's much more severe for those of you who are not grandfathered. It's actually 81 basis points, which means you're likely going to see about a 8% drop or so in your pension lump sum just from second quarter to third quarter. So again, if somebody was thinking about leaving at the end of this year, it's very beneficial to review and see if it makes sense to leave sooner rather than later. If you're thinking about leaving next year, it still may be worth a review because for a lot of you, an 8% drop in your pension is probably a lot more than what you're making quarter by quarter. So if you were leaning towards a lump sum and you're going to stay around for another quarter and even longer, because we don't know what they'll be, but it's a pretty safe assumption to think that interest rates will continue to rise here, then we'll actually start to see the fact that you might be working for free, because if you're losing more than what you make in your pension lump sum, you're essentially working for free. So if you have questions on that, give me a call and we can actually go through that with you and run that cash flow analysis to show you those different options quarter by quarter, so you have an idea of where you stand, and make sure that whenever you do decide to retire, you're making the right decision, especially if it's the pension annuity versus the lump sum as well. And then just to kind of rub it in at the bottom there, we got the interest rates we had back in first quarter of 2021. So you can see how quickly we've come up from that low of 2.27%. And right now we're getting back into the threshold of 2019 rates, and we should continue to see those go higher. So again, like I said, it's very important to give us a call, run a cash flow analysis, or update that cash flow analysis if it's been a year or so. But you can reach that 1-800-900-5867 or info@theretirementgroup.com. You could also hold your cell phone up there for some of these QR codes and look at the aspect of either following us on LinkedIn so you get more updates on the Exxon information, or scheduling a call or an appointment with myself or one of the other advisors in the office. Again, I want to thank everybody for joining us on this quick update, and I hope you have a great day.